Right now, the most valuable company on Earth is not the one building the future of artificial intelligence. You have probably watched your favorite tech stocks rise and fall on every AI headline this year. The story everyone keeps repeating is that AI is where the money is, that whoever spends the most wins the decade. That story just broke. Because the company that beat every AI giant to $5 trillion did it by refusing to play their game at all. So what did Apple know that Wall Street did not? On a Tuesday in late July, Apple's stock touched $342 a share. For a moment, its market value crossed $5 trillion. Only one other company in history had ever done that. Nvidia got there first, in October of the previous year, riding the biggest technology gold rush since the internet itself. Apple got there second. And Apple got there by spending almost none of what Nvidia spent. Sit with that for a second. Two companies. Same number. Completely different paths. Nvidia builds the chips that power artificial intelligence. Every major tech company on Earth depends on it. Microsoft, Google, Amazon, Meta, they have collectively pledged something close to $650 billion this year alone toward AI infrastructure, according to Bloomberg's reporting on the sector. That is not a typo. $650 billion in a single year on data centers, cooling systems, and chips. Apple spent a fraction of that, and its stock still climbed faster than almost every one of its rivals in 2026. Here is where the common explanation starts to fall apart. You would assume that a company avoiding the biggest technology shift in a generation should be punished for it. Slower innovation, falling behind, losing the AI race. That is the story analysts told for most of last year, when Apple's own AI-powered Siri kept slipping its release date and reporters openly asked whether Tim Cook's company had simply missed the moment. But something strange happened while everyone was watching the AI leaders. The companies spending the most started paying a hidden price. To build AI infrastructure, you need memory chips. Specifically, DRAM and NAND, the components that let devices store and access information quickly. Data centers eat these chips by the truckload. And as Reuters and IDC have both documented, the demand created a shortage the electronics industry had never seen before. Spot prices for memory chips rose by close to 700% within a year. Laptop manufacturers watched memory jump from under 20% of their production cost to over 35% in a single quarter. Every company that builds phones, laptops, or game consoles got squeezed. Sony raised prices. Nintendo raised prices. Even Valve's long-awaited gaming console launched $300 above its planned price, purely because of memory costs. Apple felt the squeeze too. It raised prices on some Mac and iPad models. But here is the twist almost nobody talks about. Apple was never competing for the same pool of chips that AI data centers were draining. It was not trying to build its own AI empire from scratch. Where its rivals leaned on Nvidia's most expensive hardware and their own custom AI chips, Apple made a quieter choice. For features like the redesigned Siri, it turned to Google's existing AI models instead of racing to build a rival system from zero. Skeptics called that a retreat. Cook's critics said Apple had lost its edge. But a retreat from what, exactly? Picture two neighbors, both watching gold prices soar. One sells the house to buy mining equipment, certain the rush will make him rich. The other keeps working his own steady job, occasionally buying a little gold when the price makes sense. When the mining boom drives up the cost of shovels, fuel, and labor, guess which neighbor is still standing without debt? That is roughly what happened here, except the shovels were memory chips, and the mining boom was the AI capital expenditure race. While Alphabet, Amazon, and Microsoft poured hundreds of billions into servers that may or may not pay off for years, Apple kept doing what it has always done best. Selling hardware people already trust, at margins few companies can match, while its services division, App Store fees, subscriptions, iCloud storage, quietly became one of the most profitable businesses on the planet. Apple stock rose about 25% in 2026. Nvidia's rose roughly 6% over the same stretch, according to CNBC's market tracking. The company everyone called the future underperformed the one everyone called behind. Why would investors reward caution over ambition? Because in investing, timing the crowd is often more dangerous than ignoring it. Every technology cycle creates a moment where spending looks like proof of vision and restraint looks like fear. The dot-com boom worked exactly this way. Companies that spent recklessly on infrastructure in 1999 mostly vanished by 2002. The ones still standing were often the boring, cash-rich businesses that waited to see which bets actually worked before committing real money. Apple is not anti-AI. It is anti-hype. There is a difference, and it is the difference that made the last 12 months so strange to watch. None of this means the AI infrastructure boom is fake. Data center spending is genuinely reshaping the global economy. McKinsey projects roughly $7 trillion in data center investment through the end of the decade, more than $5 trillion of it tied directly to artificial intelligence. Somebody will win enormously from that spending. The memory chip shortage itself proves the demand is real, not imagined. But being early to a trend and being right about a trend are not the same thing. And Wall Street, in its rush to reward anyone who says the word artificial intelligence enough times, briefly forgot that. Here is the part that should feel uncomfortable if you are honest with yourself. You have probably felt this same pull, just at a smaller scale. Every time a new stock, a new coin, a new trend explodes across your feed, some part of your brain whispers that staying out means falling behind. That whisper is not new. It is not really about artificial intelligence at all. It is the same instinct that drove people into speculative railroad stocks in the 1840s, into dot-com startups in 1999, into anything shiny enough to promise you will not miss out. Apple's $5 trillion milestone is not really a story about chips or software. It is a story about discipline outperforming urgency, told at a scale large enough for the whole world to watch. Every dollar Apple did not spend chasing the AI arms race was a dollar it kept for its own long game. Buybacks. Dividends. A war chest that lets it wait, watch, and buy the winning technology later, on its own terms, once the picture is clearer. That patience is not glamorous. It rarely trends on social media the way a bold new AI announcement does. But patience compounds quietly while impatience burns cash loudly, and eventually the market tends to notice which strategy actually worked. Somewhere between the $650 billion being poured into AI infrastructure this year and the 700% spike in memory chip prices, there is a lesson sitting in plain sight for anyone building wealth outside the stock market too. Chasing every hot trend the moment it appears rarely builds lasting wealth. Understanding what you actually control and moving deliberately within it usually does. Apple did not win by predicting the future better than Nvidia, Microsoft, or Google. It won, at least for now, by refusing to bet everything on a future it could not yet see clearly. It let its richer, more aggressive rivals absorb the risk of the shortage they helped create, then kept building the parts of its business it already understood better than anyone else on Earth. $5 trillion is not proof that Apple was smarter. It is proof that in a world obsessed with speed, the slowest company in the room sometimes finishes first. So the next time you feel that familiar pull to chase whatever is trending in your own portfolio, in your own career, in your own life, it might be worth asking Apple's question instead. Not what is everyone else racing toward, but what are you patient enough to still be holding when the race ends? Because right now, the most valuable company on Earth got there not by building the future of artificial intelligence, but by knowing exactly when not to.